Hi, I'm Jeff Sherman, Deputy Chief Investment Officer at DoubleLine Capital, and I'm here today to discuss the DoubleLine Fortune 500 Equally Weighted ETF, DFVE. Fortune is a company that started publishing an annual list back in 1955 of what they deemed to be the top 500 companies which are domiciled in the US. The way that Fortune constructs this index each year is to go through and rank companies, both public and private, based upon revenue. And what we find with the Fortune 500 is that you get a much differentiated list, and it allows you to have a different selection of securities out there that span the overall US economy. Most indices that are out there that are followed in the marketplace are what we call market capitalization weighted. And so that's simply taking the number of shares outstanding times the market price, which gives you the market capitalization. The key differentiation between an equally weighted index is that every single security within the index receives an equal amount of capital or the same amount of weight within the portfolio of securities. And so what it does is it gives you a complement to other type of strategies out there in the overall universe. It's not just one or two different names that are going to drive the difference in risk and overall performance. We think that there is the value in having exposure to some of these less trafficked in names that still sit in the top 500 revenue generating companies here in the US. The big advantage of an equally weighted index versus market cap weighted is when markets get distorted, like we saw, let's say in the late 90s, where you had this big mega cap effects where the large names were the dominating forces. Those get the most allocation in a market cap weighted portfolio. And so by equally weighting a portfolio, you're fading against that trend. And although that trend has not been popular, let's say for the last 3 or 4 years, we started to see some signs of reversal within the marketplace. The main risk that an investor faces when using a strategy like the Fortune 500 Equally Weighted Index is that if there's continued domination by the largest companies in the world and they continue to outperform the broad-based market, that is a risk that investors face by underperforming those large and mega cap names. But we've seen throughout the annals of history, going back over a century of data, is that you typically don't get this domination by the largest names. And so what you're doing is you're flying in the face of financial history if you're saying that the largest names will always continue to outperform. By having things that span other parts of the US economy, it's quite helpful in creating that diversified portfolio versus making a very narrow bet with very little breadth in the marketplace today.